Hello, my name is Paul Christensen, Christensen's Insurance Risk Analyst. On this session, we would like to discuss the risk to you and your family and business of a life insurance disability claim, either not being paid in a given health crisis event or perhaps a lesser amount than what you anticipated being paid is actually paid out by the claims department. Now, I've been in the insurance industry for over 25 years, and we've had very positive improvements and enhancements on the level of protection offered to policyholders over this period of time. However, there is buried in the policy document many issues that, from my practical observation, does not get discussed with the policyholder. And if you have a claim, you could be unpleasantly surprised. The industry has unfortunately digressed away from the core reason for why you're buying the insurance protection. And we have all sorts of gimmicks to incentivize a policyholder to buy their particular offer or option, such as cashbacks, gym memberships, pick and pay discounts, and you name it. So I don't like gimmicks. I only offer sound ethical advice, and I believe in business with integrity. Now, policyholders essentially face two key risks. The first one, as I've alluded to, is the fine print that's buried in your policy document. The second risk is the financial risk with compulsory annual increases, which I believe will become unaffordable to many families due to the fact that premium increases when you're in your 60s are going up at 9% per annum. Imagine the premiums going up, you retired, but the premiums going up 9% per annum. So the problem and the challenge is the cheap premium, the less expensive option that is sold to you after 6 or 7 years starts becoming more expensive than the base price that would have been the right option. Now, you can only imagine what happens if you don't get paid in a crisis. All sorts of dreadful consequences. Family homes get sold, as I've seen businesses collapse while people are unconscious in hospital. Divorces will many times result due to the consequences of the stressful situation. Family savings are wiped out. So there's all sorts of serious risks and consequences. Now, just to mention a few risks that are buried in the policy document, and this, to start with, would be specific to your disability benefit. It could happen that the cover expired. I've seen this where a gentleman unhappily has brain cancer. He's had an amazing recovery over the last 7-8 years, but dreadful, just before the cancer was diagnosed, certain benefits had expired. It could happen that because you've got older versions which do not include impairment, so because you've been medically determined that you can carry on by the claims department's opinion, that you can carry on working, then of course your occupational disability will not pay out. I have to labor and underline the point that if the policy is 4 or 5 years old, it is likely to be an out-of-date version, and those particular key points about expiry and not having impairment embedded in the definition is probably two of the main risks that you carry with your occupational disability. It could happen that you have a policy that's a joint life policy, and depending on how this was structured, and perhaps a spouse claimed a particular benefit, that could cause that all the benefits get deducted pro rata, as being affected by that first claim. And then there's a risk that, does your company exclude any pre-existing conditions after the age of 65? Income protection, some of the same issues as with your occupational disability. Your version, if it's expiring, again, without even checking your policy document, you can assume that if your income protection is more than 4 years old, it's likely got an expiry date. A very important issue, again, comes back to your definition. You could have been off, let's say, from work for 6 months. You return to work, immediately your income protection payments stop. Now, the fact that you were off for quite a long period of time, by implication, your business has probably taken a knock. And secondly, your productivity is going to suffer while you are still going through this recovery process. So surely it would make sense to ensure, again, that you have impairment embedded in the definition, so that a portion of income would continue to pay you out at this point in time. If you have a permanent impairment, you would then enjoy this added income to offset the impact of this during this recovery process. There's another very serious risk that a policyholder has with income protection, because typically when you have a claim, now let's supposing you insured yourself for 50,000 Rand a month. Now, for whatever the reason is, whether it was a poor business environment, again, maybe it was lost productivity due to an encroaching illness. So let's supposing at claim stage, the insurance company requires you to submit a proof of income at the time of this claim. Now, let's supposing your income has dropped to 30,000, but you are paying for cover for 50,000. You will only be paid on the basis of the 30,000 because that's the income you're proving. And we would suggest that you rather insure with our recommended insurer that will accept your proof of payment today when you apply for your cover. And heaven forbid, all sorts of things can happen going forward. So on top of the stress of being at claim stage, the last thing one needs is to be given a runaround by an insurance company that now comes up with more bureaucratic requirements. Old policies of more than 4 or 5 years ago, same. There's a likelihood of definitions again being impacted with your dreaded disease cover. There's another very serious concern I have often on reviewing client portfolios. We find that the insurer that they have their dreaded disease cover with is only paying out at end stage. And this is a very serious matter, because it means by implication that instead of getting paid out because, let's say, you had a car accident and you were unconscious for a period of 96 hours, your insurer determines that, well, we will only pay out when brain damage has been confirmed. And that could take 6 months or a year. And that to me defeats the object of having dreaded disease, because dreaded disease cover has always had that I think comfort, financial comfort, in that on diagnosis of an event, it would pay you out. Another serious matter is that a lot of companies either don't have a catch-all benefit, or the catch-all benefit definitions are very limited. So the important thing is with catch-all, you can imagine, I mean, the medical dictionary, I don't know how many, it must be equivalent to a dozen yellow page books. So how can all the likely illnesses be effectively covered in a 30-page document. So catch-all is important, because if your illness and condition is not a listed illness, you won't be covered. So ensure you have a Rolls-Royce catch-all embedded in your definitions. Another problem is that for some strange reason, insurance companies often offer 3 or 4 different dreaded disease versions, and the implication is that if you're on a degraded dreaded disease version, when it comes to a claim, whereas for a few rands difference, you could have been covered, but now that particular version doesn't cover you. Also, of course, as we've alluded above, is that the same risk you carry is when the policy documents are 4 or 5 years older. If an advisor has sold a client a degraded version, well, then I would suggest you fire such an advisor, because you are seriously being placed at risk due to incompetence. Now, you would ask yourself, why would a life insurance cover not pay out? I mean, especially since if you've passed away, you've passed away. So there are a couple of reasons. The first reason is that your policy might have been structured with benefits on an accelerated basis and not freestanding, and you've already covered, claimed your dreaded disease benefit, and that has actually been deducted from your life insurance. So please ensure that your ancillary benefits are freestanding, as we call it, and not accelerated. It could also happen that if it's a joint life policy, that the effect of one spouse claiming would reduce the cover of the other spouse. Now, we have to raise particular questions regarding the Discovery Life policy, because it is structured somewhat different to the rest of the marketplace. So the first thing is, you should ensure that your policy document is protected with 100% minimum protected benefit. That is a reinstatement benefit. So that solves, in other words, that would the result would be that you would achieve a freestanding benefit. Now, we find a lot of advisors are only structuring the quotation they've offered you with a 75% or any other lower percentage minimum protected fund. And the reason being is that it does offer a substantially reduced premium to you, so it makes it more appetizing. But the consequence is that after a claim, and so using the example of a 75% minimum protected fund, immediately after that claim, all your other benefits and your spouse's benefits would be reduced by, let's say, that 25%. That's a serious matter. It means you've lost 25% of all other benefits, and you're not the spouse that's been impacted with this illness. Obviously can't go and just apply for another 25% cover to make up the shortfall. So that's a key issue that the advisors are not perhaps giving enough cognizance to. The other thing is the Discovery Life structure. There's 2 clauses. Well, they work together. It's clauses 2.4 and 2.62. You might assume that you've got R1 million cover of, let's call it, capital disability, and you bought 500,000 of severe illness benefit. So in the worst case scenario, you claim your 500,000 severe illness. You come back 6 months later to claim your R1 million disability, because now you can't work. So your expectation is R1.5 million worth of benefits to be paid out. I'm sorry to say that in terms of clause 2.62, the minimum protected fund, on the assumption it's set at 100%, it would only be reinstated after all claims have been paid. So by implication, if you were paid already 500,000, they're actually going to deduct it from the million. So instead of getting R1.5 million, you're going to get R500,000 and R500,000. So you're being shortchanged to the tune of 500,000 Rand. Now, this is a very, to me, an unethical and misrepresented business practice, and I don't actually understand how Discovery can, quite frankly, structure a policy on such a basis. The other serious question is clause 6.8. Imagine you pay for your capital disability benefit for 20 odd years. At age 65, assuming, let's say, you have a particular ailment, it happens to be high blood pressure, as so many people have, diabetes, etc. This clause 6.8 says that at age 65, if your pre-existing condition progresses to claim stage. So now let's say at age 75, you now want to claim, you qualify for a claim, but because it was a pre-existing condition at age 65, it's excluded from your cover. I think it's a shocking benefit and a very serious, it puts you at serious risk. Imagine you pay this policy another 10 years, you've paid it the first 20 years, and now at age 75, they don't want to pay you out. I'd like to invite you to contact me. You may wish to clarify any points that I've raised. If it should happen that you are in fact shopping for a quote at the moment, you could really save yourself a lot of heartache in the context of all the points of itemized, and you would certainly save yourself a tremendous amount of time. You merely send your quotation that you've been offered to us, and we'll provide you with a written commentary of issues that we feel you should seriously get clarity on. And then the second issue is this financial risk. Now, most policies are being sold with this age-rated, as we call it, compulsory increase, which in your retirement years would go up to 9%. I imagine, so you start off with a so-called cheaper premium, but within about 6 years, it's now caught up with the standard and level costed plan. So ultimately, over about 15 years, this so-called cheaper policy is going to end up costing you probably about 100,000 Rand. I haven't costed it exactly. 100,000 Rand extra per 1,000 Rand of premium over 15 years on that insurance policy. I mean, it's a shocker. And the insurance industry at large has created a financial time bomb, and it has seriously prejudiced you as the policy holder. And then lastly, if you are a Discovery Life policy holder and you are on Vitality Blue, you seriously need to buy into their business model, which implies that you've got to take action annually to not sit on Vitality Blue and at least get on to silver. You know, there's bronze and then silver, to avoid these additional extra premium increases of up to 3%, compounding on top of the compulsory increases, which I've just explained are very serious. Should you wish to investigate and get peace of mind, get another opinion, we offer you this complimentary assessment. We would welcome and look forward to hearing from you. Pop us an email or call me on 081 422 880. And I want to thank you, a hearty thanks for sharing this discussion with you. And we look forward to being of service to you and your family. God bless.